Hey, fools. All right. It is Tuesday. It is time for the Millionacres Hour. We're going to talk about REITs this hour. So get your questions into Backstage Pass. We're going to do all kinds of like REIT basics today. So I wanted to introduce Kayla, who runs our content at Millionacres, and she's a relatively new REIT investor, right, Kayla?
Yes, I invested in my first REIT probably about a year ago at this point. So I am very new to the game, but working at Millionacres, I was exposed to so much content surrounding REITs and so many experts in the real estate investing space. So I figured why not get invested? Actually, literally invested in REITs. So yeah, here I am now as an actual REIT investor.
I love it. So had you heard of REITs before joining Millionacres?
I had not. So I joined Millionacres a couple years after graduating college. So I really did not start my investing journey myself until like a couple years out of college, which I feel is very, very normal for the typical investor. Obviously, you need a certain amount of capital to actually get invested. You have to be saving money aside each month. And I think one of the great advantages to REIT investing is you don't need a lot of capital in order to get started with it. So that was how I got started in REIT investing, is seeing that these are stocks that are not only affordable, but have low barriers to entry and high profitability and high potential to gain.
Well, I think one of the things that that's interesting is that REITs they don't necessarily attract the younger audience, and I think there's a few reasons for that. They're not sexy tech stocks. Elon Musk isn't running a REIT. And they're not doing the kind of growth that maybe people who can take on a lot of risk are kind of looking for. Matt DiLallo, when did you get started investing in REITs?
It was probably around the same time Kayla did. I think I was in grad school at the time, and I was getting my MBA, so I was really interested in finance at the time. And REITs just seemed to be something that fit what I liked. I really like real estate investing and really wanted to get in, either flipping properties or buying apartment buildings, but that just costs so much money for somebody that didn't have anything at the time, and REITs just fit that. And I'm somebody that really likes passive income. I just like getting paid for stuff I'm not doing, and REITs just fit that, and it gave me cash flow that I could use to invest in higher risk stuff. So that's been my philosophy kind of for the past, I don't know, 10-15 years, is buying dividend stocks and using that to invest in higher risk stuff. And that way I feel like I'm putting capital at risk that I can really afford to lose because I didn't really have to work to earn that money.
Well, I think that's an interesting strategy. And I think that's one of the reasons that people really first get drawn to REITs, right? Is that idea of like, hey, it's guaranteed to give me a dividend. So I think that's something that certainly draws people who are retiring. They like that source of income. And I think that's why REITs tend to skew toward older people. But I think really just about anyone can should invest in REITs, and you can put them in a retirement account, which is nice because then your dividends just can be there and you can just use them to buy more shares or buy other things. So Matt, did you have other stocks that you were invested in and then you came to REITs later, or did you sort of come to REITs at the same time that you came to other stocks?
I think it was a little bit later. I really didn't know what I was doing at the time. So I would buy things that, I read in like a business school textbook. It was like right after the dot-com bubble. That was when like my business textbook was written. So they mentioned some of these tech stocks, and I'd look at them, it's trading like $5 a share. Ooh, it's cheap. And it was cheap for a reason. I didn't know what I was doing at the time. But, as I kind of learned more and more about how businesses operate and what type of investor I wanted to learn to kind of be like stability, cash flow, value were kind of how I skewed, and REITs just really fit into that.
Yeah, that makes a lot of sense. I think for a lot of people, that idea of it being relatively stable, and I feel talking about REITs for the past year, it's been sort of interesting because last year was such an anomaly for REITs. And anyone who heard us talk about REITs last year and then sort of looked at what they were doing, were probably thinking like, what are these people talking about? But really for buy and hold over the long term, REITs are just so consistently steady. And that's one of the reasons that people like them so much, is that when the stock market is being crazy, REITs are usually relatively steady. Last year was because businesses were shut down, because physical real estate was closed. Not so great for REITs, but REITs have had a phenomenal bounce back. And I think one of the things that's most interesting this year is I see the Wall Street Journal writing about REITs on a regular basis. I see much more attention and interest going toward REITs this year because they're having such a great bounce back. But I think it's really sort of opening people's eyes up to the idea that REITs are actually a great thing to invest in, and a great way to play some of the trends that we're seeing right now, like e-commerce with industrial real estate, data center REITs, and the massive amount of data that we're all consuming. And it's been sort of fascinating to watch REITs become more interesting in the media, which is fun.
Yeah, I can definitely speak to the growing interest in REITs, even in the last year or so. As a content manager at Millionacres, I'm responsible for overseeing the distribution of content across our free site. And I can say we've seen an enormous growth in interest in our REITs content over the last year, which is just amazing. We're definitely, very encouraging of members to look into REITs and buy REITs, and our numbers are definitely speaking to that right now.
Well, let's talk. Oops, sorry. Go ahead, Matt.
One thing that I just find so fascinating about REITs in real estate overall is it touches like everything that we do as a society. Like, yeah, we're all remote right now, but so much of what we do in society requires real estate, and REITs allow you to kind of play that on just a lower risk way. You mentioned e-commerce, and for a lot of investors, to balance out the risk of like your Amazons and your high risk, high volatility e-commerce platforms, you can buy warehouses through REITs that they get, this very steady rental income. And it's just a good way to balance out the volatility. You can play the same exact plays. Like, you talk about 5G. Well, there's REITs that focus on that, data centers, and all these different plays out there that are growing rapidly, but these just offer a lower risk way to play that. And just, it helps to offset the volatility, which, we haven't seen a lot of volatility in the past year, but it'll come again, and REITs will be a great way to kind of balance that out.
Yeah, absolutely. And you made a good point about it touching everything. One of the things that I think I've started to do lately is every time I see a for lease sign somewhere, I'm like, oh, which REIT is that? Who's managing that? Or you start thinking about all the places you go that REITs touch, every time you're in like grocery stores or Starbucks or, so many different places that you physically go into, as well as you mentioned with e-commerce and things like that.
Yeah, I have started to notice so many REITs in my day-to-day life. Like, I'll be in a strip mall and I'll see that it's a Simon Property Group property, or I will see that, a friend sends me a funny message in her apartment building's community portal and it's a Brookfield property, or I'll pass a Jones Lang LaSalle building on my way to the grocery store. I live in urban Philadelphia, so I'm surrounded by REITs all the time. And they're truly everywhere, which is another reason that I am invested, because they're just so prominent in our daily lives.
Well, let's go into some of the basics about REITs and what makes them different from stocks, because they follow some of the same rules, but they also have their own rules.
Yeah, so people have to think about REITs as like basically a portfolio of cash flowing real estate properties. So a lot of them will focus on different types of real estate. We mentioned industrial properties, your warehouses, office buildings. And so REITs will just focus on this. Congress created REITs back in the 1960s to allow any investor to kind of access to this cash flowing real estate, which was like the domain of the very, very rich. And it leveled the playing field to allow anybody to get in on this. And they're a little bit different from stocks in that there's some different metrics. Metric that you'll see on Millionacres all the time is FFO, which is funds from operation. If you're familiar with stock investing, we talk about earnings, but FFO is just, it's like the cash flow REITs, after they get their rental income, they pay all their expenses. That's like the cash flow they have left. That's what they can pay their dividends with. So there's a little bit of differences from stock investing, but you're still looking at a company. What they own is, a portfolio of real estate that generates cash flow. So very similar to what you look at, like, any type of business out there that has recurring cash flow, like like Comcast, for example. You pay your Comcast bill every month. It's kind of similar to a REIT. They're getting the rental payment every month. So it's that type of business model out there where it's just you're getting this recurring cash flow stream, and it just makes that cash flow allows them to pay dividends, and dividends have been like great ways to grow wealth over the years, and it allows them to buy more properties. So it's just a great business model. It's why they've been so successful.
Right. So a couple of the rules for REITs that they have to follow is that they have to pay out 90% of their taxable income in the form of shareholder dividends. So that's I think the fact that most people know about REITs. But there are some other rules that they have to follow. For example, they have to invest at least 75% of their total assets are in real estate assets and cash. And that's interesting too when you look at a company like Simon. They're invested in their malls, of course, but they've also taken shares of a variety of different tenants over the years. And that's been sort of another business for them, but they have to be careful to make sure that they're following that number of total assets invested in real estate and cash. So some other rules for them, they have to derive at least 75% of the gross income from real estate related sources. So that relates to the percentage of total assets as well. And so for some companies, they may start off as a private company and then become a REIT later on.
And it's, all these rules are designed by the IRS so that these companies will qualify for this tax advantage. And one of the reasons why we like REITs so much is they don't pay corporate income tax. As long as they follow these rules, they don't pay corporate income tax, and that saves their average investor from double taxation. So if you own Apple, for example, they generate all this profit, they have to pay corporate income taxes, and then they pay a dividend, and then the investors have to pay taxes on that dividend. Well, REITs, they don't have to pay that corporate income tax. And then if you own REITs in a IRA, you don't have to pay tax on those dividends. So you almost get a double tax benefit. And that has really been one of the big things that's helped the REITs create all this value for investors all over the years, because they're not paying the government all this money that other companies are paying.
Right. But one of the complexities of that is that you can't necessarily look at REITs the same way you do traditional stocks, partly because of depreciation. And so that's one of the reasons that we use funds from operations as a more accurate assessment of how the company and the REIT itself is performing and how its properties are performing.
Yeah, and not to get into the complexities of how to calculate funds for operation, but just think of it as this is the amount of cash flow that they generate, similar to earnings. But if you think about a business, it's like the free cash flow. So it's not even the earnings, it's the free cash flow. They can do whatever they want with that. And the difference between REITs and regular stocks is, you had mentioned the 90% rule of having to pay their actual taxable income. Well, REITs will, in a lot of times, pay more than that because of the funds from operations. They've got this extra cash flow because of depreciation. So you don't really have to pay so much attention to the net income and all those type of taxable numbers. But as this funds from operation, this is the number that's so much more important, because this is what they're kind of banking every quarter, every month.
Exactly. So I wanted to run through some quick REIT facts that I was looking at when I was doing some research on REIT.com today. So currently, REITs own more than $3 trillion in gross real estate assets across the US. And the interesting thing is that divides out with the stock exchange listed REITs owning around $2 trillion, and then listed private REITs and non-traded REITs make up the other $1 trillion. And so we talk about people owning REITs, but I think a lot of people may not know that they own REITs. 145 million people own REITs, but a lot of that is mutual funds and retirement accounts. So if you've got money invested in there, you may actually be already a REIT investor and you may not even know it. And REITs own, I love this number, 516,000 assets across the country. And one of the things that I find really interesting about REITs is they're not that old when you consider the rest of the stock market. They started in around 1960. And in some sectors, there really isn't a huge amount of REIT participation. Retail, fairly saturated, but things like a lot of medical, there's still a lot of medical that's privately owned. And one of the things that I've been watching a lot, I know Matt and Kayla have also been watching, is that we're in a kind of an interesting situation where the average age of commercial real estate landlords is getting older, and you're seeing a little bit more consolidation. Still, most commercial real estate is not held by REITs, but you're seeing more consolidation toward REITs in some sectors, which I think is really interesting to watch.
Yeah, there's so much real estate out there that's privately owned, as you mentioned, mom and pops, smaller companies, even companies themselves that, like an Apple, I don't know offhand, but they probably own their big, corporate office. A lot of companies do own their, corporate offices. They'll own, critical real estate distribution centers, and they're starting to sell this off to REITs. Hospitals are another thing. A lot of times the hospital will own the real estate, but realize that it's critical to their business, but it's not critical that they own the business. And they can free up a lot of capital that they have tied into this. The money that they spent to build it or to acquire it, they can free that up. And then instead of it being capital expenses, it can be an operating expenses, because leases are operating expenses that they can take off of their for tax purposes. So it really works out for a lot of these companies to sell these properties to REITs. They call it a sales leaseback transaction, where the owner the operating business will stay in that building. They'll sell it to the REIT will lease it, and works out great for both, because the REIT gets a steady income. They get a property that the tenant really needs, and it's a really great win-win solution for everybody involved. So we're seeing a lot more of that, and it's bringing up different REITs that'll own things that they really didn't own before. Farmland has kind of come up in the past couple of years, where farmers are selling their land to REITs and leasing it back. We've seen a lot in the technology industry with cell towers, for example, have gone over to REITs, and you have like Verizon will lease the space back, and then other tech companies will lease space. So it's really opened the door, and we've seen things that you wouldn't necessarily think as real estate, but if it's got that lease type structure, it really works well for REITs, because it provides them a steady cash flow.
Yeah, and I think one of the things you and I have covered, you and I did a show a few weeks ago about mergers and acquisitions in the REIT space and in real estate in general. This has been just a crazy year for that. Last year, not so much. Obviously, a lot of people waiting for prices to fall. A lot of people thought that prices of real estate were gonna plummet. That didn't happen. They thought that there was going to be heavy problems in commercial real estate lending. Still higher than average, but we're not seeing the gloom and doom that people were predicting. So I want to share my screen for a second, because I want to show the most recent data on from REIT.com. Let me see if I can bring this up there. Can you guys see that?
Yes.
All right. So the reason I wanted to share this for a second is just to look at sector-specific real estate and what we've been seeing with REITs in terms of this amazing year. So some of the numbers that kind of jump out to me, you see the equity REITs obviously doing well, but look at some of the numbers. I mean, self-storage is up, almost 43%. Not a surprise to see residential bouncing back, because we saw rents drop a lot last year, especially in your coastal areas. We saw that in San Francisco. We saw that in New York. Now, half the stories I think Kayla and I are covering are all about, rents going up here, rents going up there. So interesting to watch what's happening.
Yeah. Go ahead.
Sorry, go ahead, Matt.
Okay, I'll start then. So one of the things, and I'm going to cover kind of rules to REIT investing a little bit, but this kind of touches on that a little bit, is a lot of these different REITs have different lease structures. So you mentioned self-storage. anybody that's rented a self-storage knows it's month to month. So they can raise that rent every single month if the market, kind of demands that. And that's one of the reasons that's driving this. Demand is so crazy for self-storage because people are moving, they're decluttering. There's just so many reasons that people need self-storage. And so these REITs are able to just consistently raise the rents as market rates. Same thing you mentioned, residential. These are typically 1-year leases. And last year was a bad time for these REITs, especially in the coast, because people didn't want to rent apartments. But this year, everybody's, because they can't find houses, needs to rent an apartment. And I've seen double-digit rental rate increases in big cities, even across the Sunbelt region, just crazy. And that's all based on how quickly these companies can raise rents. Some of the others where we don't see so much of this is because they can't raise rents as quickly, like office rents, typically 10 years. Some of the industrial might be 15 years, but we're still seeing a lot in the industrial. But some of that is into play as they're just able to get so much extra rent now because of demand.
Yeah, I would imagine that self-storage has been so popular lately because of the housing market that we saw this summer. People were so emphatic about selling their homes because it was quite a seller's market that we saw and are continuing to see. And people, I would imagine, are selling their homes quickly and needing to buy new real estate, might have some time in between. So, makes sense to me that self-storage has been a really, growing sector.
One thing, so this is kind of when I was a beginner REIT investor, I really thought that a lot of self-storage was based on that moving thing, and it was kind of temporary. And I thought like a bad housing market would hurt self-storage, and it does to a little degree. But what I've found interesting over the years is that I've learned, and I saw this in an investor presentation a little bit ago. They call them like Hotel California, where once you're in, you never leave. And they say that people think they're going to rent these for a couple of months, and they end up renting for a year, 10 years, because they just have all this junk. And I've even heard anecdotes where it would be cheaper for people to buy a dumpster, rent a dumpster, and trash all their stuff and buy new stuff than to rent a storage facility. So it's actually such a fantastic business, and relocation is only part of it. So that's kind of like one of the things that as you get into REITs, you find all these fascinating things about how good they can be as businesses, and self-storage is one of those really fascinating ones.
The other thing I find really interesting about self-storage is that there's only 5 listed REITs there. Most of self-storage is still small mom and pop. Even the biggest players like Public Storage don't have as big a share of the market as you think. So that tells me that there's still room for growth. There's a lot of concern about overbuilding in self-storage, and that's definitely a factor because it's one of the easiest things to kind of pop up. But it's also something that really can benefit from consolidation. And that's another reason that I wanted to bring up this chart as well, because it's a great overview of the different types of REITs, market caps. I think one of the things that's so interesting is that in some areas, there are only a few players. I mean, you look at infrastructure, 4 major players and a $245 billion market cap. I mean, that tells you that there's really, that pretty much, I think you could probably invest in any of the companies within that sector and probably do okay. But retail is one that is one of the bigger sectors, and certainly one that was hard hit. Kayla, we've covered so much retail this year. What are you seeing in terms of retail trends right now?
Well, we're seeing a lot of retailers are gearing up for holiday season. So, we're seeing a lot of strategies in place where retailers are trying to make up for the revenue that they lost during the pandemic. But we're also seeing a lot of retailers focus on their online sales. So that ties into warehouse investing as well. I think when you look at retail, you have to think of industrial REITs as well, because so many of these retailers are relying on warehouses in order to store their inventory.
Oh, absolutely. So before I bring down this slide, I just wanted to mention a couple of the sectors that aren't doing quite as well. They're still bouncing back, but are still sort of a little bit unsteady so far. One of them is healthcare, partly due to just how much senior housing and nursing homes were impacted by COVID-19. Things are shifting, things are bouncing back. People are feeling more safe about those types of facilities, but really tough year. And the other thing is office. I mean, we've all talked about remote work so much, but I think one of the things with office, Matt talked earlier about leases. With office, you're looking at a 5 to 10 year lease most of the time. And so a lot of companies are in that space right now where they're trying to make a decision for 5 to 10 years from now. And that is just so hard because we hear all about hybrid work. We hear about the great resignation of people deciding that they're not going to go back to the office at all, or they're not going to take a job in a place where they're being required to go to work 5 days a week, 40 hours a week. So all of that is making the office sector a little unsteady, a little bit uncertain. There's so much to figure out. I mean, the bright spot that we've covered a lot at Millionacres is life science. Matt, I think you might have written up the story about Moderna and Alexandria Real Estate Equities. That's one of the REITs that we've followed, and I know it's a recommendation in at least one of our services, because that is a company that was kind of perfectly positioned for suddenly a lot of people looking for life science office space.
Yeah, it's astounding how that particular sector is doing. I was looking at their numbers to write that article, and they had historic volume. I think they leased like 1.9 million square feet of space, and that was a record for them. And the historic rental growth, I believe it was like 20% or more rental growth on like new and renewal leases. It was just an astounding amount of demand because the governments and investors have poured so much money into life sciences companies to help with the pandemic that they're flush with cash. And so they're expanding. And that is just really good for them. It's really good for Boston Properties. It's another office REIT that focus on that. Not so much as Alexandria, but, and that's one thing that I'm gonna touch on a little bit later, but what a REIT owns is so important because it can be in a sector like office, but it has the right properties or in the right location where it's going to benefit. For example, San Francisco is a place that people don't really want to live because it's so expensive.
Right.
And offices in that city are having problems getting people back to work. New York City, not so much. I mean, people really do like New York City, but even more so in the South, the Sun Belt region, Atlanta, Nashville, just to name a couple. People want to move there. They want to go to offices there, especially if they're, these high, if you can get a highly amenitized office in Atlanta, it's going to draw people in. And REITs like Cousins Properties are really benefiting from this. Is companies move into these regions and they're moving there specifically to bring jobs to the region that will require offices. I know Visa just signed a lease in Atlanta with Cousins, and it's one of many companies that have signed office leases in that place because there are people who actually want to go to work in those cities because you don't have the traffic and the costs as you have on the north.
Yeah, and you have the warm weather. So, I can't tell you that in Philadelphia, I'm begging to, walk 20 minutes to an office in the 30-degree weather. So that, that definitely is a factor there too.
All right. Do you guys want to dive into a couple of questions?
Sure.
Absolutely.
All right, we've got one from Sanjay about what do you think of Store Capital, ticker STOR? It says early during the pandemic, executives in the company invested in the stock, but since then there hasn't been meaningful insider buying. Do you think the dividend is sustainable? I think part of the reasons that the people invested early in the pandemic is because the stock was cheaper, and Store has had a steady bounce back since really with the reopening stocks that we saw kind of. REITs started to tick back up in November. I mean, Store Capital is certainly one of our favorites in terms of solid investments. What do you think about the dividend, Matt?
So I'm going to start with, I mentioned I've got some rules for REITs. And one of my first rules for REITs is to know what they own. And anytime you're going to get started investing in a REIT, look at what it owns. And because that can play like a huge role. So you mentioned Store Capital. It's a retail REIT, but there's basically three types of retail REITs. You've got the REITs like Simon Properties that owns these massive indoor enclosed malls. That was really hit hard by the pandemic. It's also facing pressure from your just e-commerce, because a lot of those stores that would be in a mall are, better suited sometimes for being online. Well, then you also have grocery anchored shopping stores, shopping centers. Those did really well because people have to go to the grocery stores. Yes, you can kind of get groceries online, but you see a lot of people still going to the grocery stores, and that traffic that goes to those grocery stores will also go to maybe the barber shop or whatever else is in that, shopping center. And then you have what are called freestanding retail buildings. They might be near a shopping center, on a shopping center, but these are what a Store Capital will own. It might be, and I don't know their portfolio as much as and others, but let's say it's a Home Depot that is a freestanding Home Depot or Lowe's or something like that. It's a store that people are going to all the time if they own a home, they have projects. It's a great credit company. They're going to pay their leases. They're going to stay there for a long time. And it's signed to what's called a triple net lease, where the tenant's responsible for insurance, maintenance, and real estate taxes. So it's a really great, stable property for these type of companies. And that's why Store Capital has done better than other REITs, is they own these type of retail buildings.
How do interest rates rising impact REITs?
So there's really two ways I would see them impacting REITs. One is, REITs have to borrow a lot of money because of the dividend rule. They have to pay out, like we mentioned, 90% of taxable income. A lot of times they'll pay out even more as a percentage of their cash flow. So they're borrowing money to fund acquisitions, development projects, and that sort of thing. And that requires, taking on a lot of debt, which is tied to interest rates. So if interest rates were to go up, depending on, when how much money the REIT needs, that could, impact how, much their interest that they're paying on their debt would cost. And especially like, for example, if they borrowed money really cheap, a couple of years ago and the debt's coming due, but now interest rates are up, they might have to pay more for that. So that's how it impacts operations. But the other side of it is a lot of times when interest rates rise, investors will sell off yield-bearing instruments. REITs are a prime example of that, high dividend stocks, because they can now get better rates on their bank CDs, they can get better rates on government bonds and even corporate bonds. So that risk reward kind of skews towards those safer options. So we definitely typically see like a compression in the yields of, the dividend yields. Right now, dividend yields for REITs are like 3%, which is really, really low. I think last year they were closer to 4 or 5% on a lot of them. And, so investors just won't buy REIT stocks. And the other way REITs fund their business is by issuing stock. So when their dividend yield is high, they have like a lower valuation, and that just makes it, they're diluting their investors more every time they issue stock. So right now, however, is a great time for a REIT because interest rates are low and their dividend yields low, so they can issue capital really cheap. And that's why we're seeing all this M&A, and they just have so much financial flexibility right now.
Is there a concern though with REITs right now? You mentioned cap rates earlier. I'm seeing a lot of concerns that some particular types of real estate are too high priced. Industrial is the one that keeps coming up for me. Are you concerned that some of the industrial stocks or industrial REITs are being overvalued and that they can't actually expand because the prices are getting too high in certain areas?
I think that's the $1 million question. And if anybody had that answer, they
Right.
would be rich. Because you look at industrial real estate for, on the one hand, the tailwind that's driving that is we need, I think it's 300 million square feet of just space for e-commerce. And then there's also that tailwind of we have, you hear about supply chain issues, they can't get stuff here. And so businesses need to store this. So we need millions, if not 1 billion square feet of more industrial space within the next 5 years just to support the growth. Problem is there just isn't that space available to even build. they're just the barriers to entry of where real estate is and where these companies need it. So it's going to be really tough for them to meet that. So that just makes the existing stocks so much more valuable because they can raise the rents on that. And if Amazon is going to pay whatever it costs to get that prime location because they are all about next day, same day shipping. And if companies want to do that, they have to pay this prime price for this real estate. So, yeah, you look at industrial REITs trading at, 30 times FFO, which is a really expensive rate. I like to see REITs at 20 or less, but then you look at how much they're growing and you can justify that. Just like you look at a stock and it might be trading at 50 times earnings, but if they're growing at 50% a year, that's, a good investment. So, it's really tough. If the economy keeps growing and demand keeps growing, then this is going to be still going to be a good investment. We're seeing really, really smart people in the real estate space. Brookfield, we've talked about before, Blackstone, Sam Zell, they're all wanting to get into the space because they see this as being a mega trend, a multi-year mega trend of growth. So I'm going to say, I think that yes, they're expensive, but I don't think that we've reached that peak where it's just out of line.
Yeah, I would agree with that. I know that one of my favorites, Americold, which is ticker Cold, has there's been some talk about that one being overvalued lately, but I'm still a big fan. Prologis also, ticker PLD, that one gets talked about a lot as being overvalued, and I also own that one and don't plan to part with it soon. One of the things that I like about Prologis in particular is just how global it is, and the fact that it's, it really, they're continuing to just expand and expand.
Yeah, in cold storage, you mentioned that Americold, they're actually facing a different headwinds, which I covered that for our Trailblazer service, and I thought it was interesting. It's a different type of REIT in that we're seeing labor issues really impacting them and
Yes.
impacting their customers. And so they're facing kind of near-term headwinds. So if that stock comes down, that just makes it more attractive because you look at the long-term tailwinds of we're doing so much more of food with online, and they're well positioned for that. So I'm really interested to see if they'll come down anymore because I think that would be a really good investment just because of how much they've got growth wise.
Yeah, I think if that one comes down, I'm going to add to my portfolio.
I feel like labor shortages could actually be like a topic for an entire webinar because I think it impacts multiple sectors in real estate. You have warehouse workers who, it's just so difficult to get employees right now. And that can impact retail. It can impact industrial real estate and warehouses, really all sectors. And it'll be interesting to see what happens with that because, we need people to run these operations.
Yeah, that's not even including all of the construction labor issues that are facing home builders and multifamily. And one of the things, Kayla, that we've covered is the supply chain issues. And Matt mentioned that earlier. I know Lowe's is ordered early this year. A lot of companies are ordering early, which is good. But I forget, I don't know how many ships are now off the coast of Long Beach, California, but it's gotta be, last time I looked, it was like 70 ships. That is really impacting everything.
Deidre, I lost you for a second. I don't know if I cut out or if you cut out, but it sounded like you may have been referring to the port congestion issues.
Yes. Yep.
Yes, that is a big issue right now impacting supply chain. It's been very interesting to read about, however, very tragic.
Yes. Let's answer this question from Kruger, which is, what are the main filing concerns for REITs and taxable accounts? I've heard that non-tax advantaged portfolios have considerable issues with these investments. I would say that mostly comes down to dividends and how you want to report dividends on your taxes. And I think that's one of the things that might be, it's a little bit different than stocks sometimes, is that you have to make sure that you're accounting for dividends.
Yeah, so there's two different types of dividends. There's qualified dividends, which means it qualifies for the lower capital gains tax rates, which is 0, 10, and 15. And then you have non-qualified dividends, which are taxed at your ordinary tax rate, which can go as high as, I believe, 37%. So REITs fall into that non-qualified category, which is why if you own a REIT, it's probably best to put them in an IRA. Now, I own some not in an IRA just because I like to have that cash flow, and I have a good accountant that can help me get deductions with other things. So, but so if you're it really depends on what your income level is. If you're a high net worth person, definitely put your REITs in a IRA because that'll shield more of your taxes. If you're, have lower income, it probably doesn't matter as much. Or, like for example, in my case, I want to have REITs in my ordinary brokerage account because at some point I want to use that cash flow to live on, because I don't really, as much as I love writing for Millionacres, I really would prefer not to do that until I'm 65. I would like to, have a boat or something like that, and use my dividend income to pay for that. So I'm keeping some of my dividends outside of that for that very purpose. So it all kind of goes on what you want your life to be in the future. I want to have, kind of have that income building now instead of having to go and buy a bunch of REITs right before I want to retire.
Well, Matt, now I'm kind of hoping that your portfolio just does not do well at all because I want you to write for Millionacres forever, right?
I have a long time to go.
On.
Part-time. I'll do it part-time.
Okay, fair enough. Fair enough.
Well, one of the things I think that's important to kind of mention is that sometimes people will say that they don't want to invest in REITs or in real estate in general because they're concerned about taxes. So I would say to people that are feeling like that is don't let that scare you off, because it's not as hard as you think. It's just a question of once you learn the rules, once you know what you have to report, you can certainly work with a great CPA. And sometimes I hear people say, well, I don't want to invest in real estate, it's too complicated. It's like, no, what you're going to get the benefit out of it, you'll be able to pay the CPA.
Yeah, and I would say if taxes are any sort of an issue, just put it in an IRA and you don't have to worry about it, because you don't have to report the dividends on that anyway, so it doesn't impact your taxes at all.
Let's answer this question we've got about Digital Realty Trust, ticker DLR, because that's one that he's wondering if it's overvalued. It's gone down a bit in the past. Pretty much it was one of those ones that was impacted a little bit by that reopening. And so it went up a lot during the pandemic when people were using so much data and people were putting a lot of faith into data centers. Now it's gone down a little bit, but it's one of the biggies in the data center space. Matt, how are you feeling about that one?
If you look at data centers overall, yeah, they're probably overvalued because I think they're trading at like 25 times their FFO, which in REIT speak, I would say 20 is where I would be comfortable with. But the other side of that is growth, and investors pay more money for companies that are growing. And this company is growing, it has a history of growing. I think it's grown its dividend and its earnings at a double-digit rate for like the past 10 or 15 years. And that doesn't look like it's going to change, because even if we use a little bit less data as companies go back to the office, we're going to be using a whole lot more data in the future. It's just the way things are going. We have driverless cars hopefully coming. We have just so much more in the cloud, streaming, you name all the datas of driving, the factors driving data. And we're going to be using so much more data in the future, and companies are learning how to use data to make informed decisions in the future. And that's just going to make data kind of flow back and forth a lot more. So we need more data centers. They're one of the best at it. So, I wouldn't be worried about it being overvalued, because I think they're going to grow into the valuation and continue growing after that.
I have to share this quote from Gary, who says, I joined Real Estate Winners in February, migrated about 25% of my IRA to dividend paying REITs to replace work income. I just retired last week in large part due to this type of planning. Thanks. Love that. That is awesome.
That is great.
Question from Dana. Can REIT investments replace bond ETF allocation during low and rising interest rates?
That is an interesting question, because there's a lot of talk about the old 60-40 portfolio where you had 60% stocks and 40% bonds. And with interest rates so low, who wants bonds? But one of the things that they've done studies on some of these big mutual fund and investment things is how good REITs are as an addition to a portfolio. Maybe you take a little bit of your stock and a little bit of your bond and you put REITs in there as a slice of like 5 to 15% is what they're saying. And that really helps to reduce the overall volatility of the portfolio. And that type of portfolio will typically perform better than the 60-40 portfolio. There's a lot of studies. I know I've written articles on it, on how that works. So I would look at NAREIT, which is the big kind of association for REITs. They have a lot on there of how to construct a REIT portfolio with bonds. They've got that number that I mentioned, that 5 to 15%. So look at that if you're interested in learning more. But that's kind of the guide I use. Is I like to have about 15% of my portfolio on REITs because they're just such great wealth creating vehicles.
Yeah, there was a study that came out recently that showed that equity REITs are outperforming private equity funds, and I know that's something that a lot of people think that you can't. That a lot of the best opportunities are not in the public market, and I think that is not necessarily true. And REITs is one of the ways that you can kind of we talk about it a lot about you can kind of invest like billionaires, invest the way that most people, especially the ultra net worth individuals, how do they make money? A lot of their money is through commercial real estate. So REITs really give you a chance to kind of do that. And the other thing that's so great about that is you can also diversify within the REIT space. I know that that's something you consider as well, Matt.
Yeah, I love real estate and I love architecture, so it really plays into what I like. And so a lot of what I'll look at when I'm looking at REITs is what do I really like, and then try to find the best company in that space to kind of put in my portfolio. And if you look at how REITs have performed over the long term, they've really outpaced stocks, and it's over decades, not necessarily over the past few years, but over decades, that compounding of the dividends that's growing and the capital appreciation that really works. And REITs have even outperformed a lot of the private ones because of the fees that investors have to pay. If you're in a private equity fund, real estate fund, you're typically paying what's called 2 and 20. So it's 2% annual management fees and then 20% of the profits. Well, with REITs, you're paying the management team. So the same thing that you would do if you're, Apple, you're paying Tim Cook and his management team to manage, you're paying the REIT management team. And that just lowers the cost, and it allows more of investor capital to kind of compound into real estate. And that's one of the many reasons why they've done so well.
Well, we've got about 5 minutes left. Kayla, I realized we didn't ask you, what was your first REIT?
My first REIT was Stag Industrial, which proved to be a very good one. I was actually looking at my portfolio right before we hopped on, and it was my first REIT and most successful REIT so far. So we'll continue to hold that one for a while.
Excellent. Yeah, talking about industrial, one of the things that's great about Stag is it's a mix of warehouses, but also manufacturing facilities as well.
Yeah. And I remember, as you were talking about at the beginning of this little chat, when I went to go buy this specific REIT, I did think to myself, like, wow, this is like kind of boring. Like, do I really want to spend my money on this specific stock? And turns out it's outperforming some of the more exciting stocks I have in my portfolio. So I am definitely a REIT investor for life, and will continue adding to that position as well as others that I have.
I actually just bought Stag Industrial, kind of for the same reasons. It's such a great performer. Industrial buildings aren't like all that exciting, but the business is so exciting because they're benefiting from e-commerce. And then Stag in particular, the onshoring of manufacturing. Like we've realized that we need to make stuff here in order to have it here when we need it. And they're going to be one of the beneficiaries of this, kind of reshoring of stuff too. So you got two tailwinds going there. So I really like it too.
Yeah, I think you just mentioned something really important there, which is the reshoring thing, because I see that as a long-term trend. It's certainly something that's buzzy right now, but we talked about the supply chain issues. It's going to take at least a year, they're estimating, for everything to kind of shake out. During that time, companies, of course, they're trying to get the goods they've already ordered over to the US, and that's step one. But then they're starting to think about where else can we make these goods and still, and have them closer next time. And I think that is one of the things that I find most fascinating, especially too with the ports on the West Coast being so jammed up, and maybe that's going to push activity more toward the ports in the East. There's been talk about Jacksonville, Florida, for example, has a big port. So one of the things, if we think about REITs, we're really thinking about kind of everything that happens in the world and how it all flows back through real estate, and how that then impacts our investments.
Yeah, we've really seen, while real estate has changed over the past year, people want different things, and that's made some change in what REITs are going to be performing well in the future. Even though we've been away from real estate, we've kind of realized how valuable it is to us and to our daily lives. And that, I think, is only going to be more proven in the future as we go back to the offices, whatever way that will be for companies. There's just real estate is just so vital to so many things, and that's just what makes REITs so great. Is anybody for just a little bit of money can start investing in these, and you can build yourself a great portfolio of businesses that are going to do very well, we think, over the next years and years and years. And it's just such a great and exciting thing.
As we wrap up, we've got a question on, can we each recommend three REITs we own? Well, we can't recommend, but what three REITs do you have in your portfolio that you really like?
I can start.
Okay.
I really like this one called Medical Properties Trust, which is a REIT that owns hospitals. We've seen hospitals are just so vital to our society, and it's something that they've done very well buying hospitals. I really like Cousins Properties, which is a REIT that focuses on office buildings in the Sun Belt region. They're growing very well. A lot of companies are relocating and they're getting offices there. And Invitation Homes, which owns single family homes that they rent mostly in the Sun Belt region. They're doing very well. Rents for single family homes are growing like crazy, and they're really benefiting from that.
Awesome. I'll go next. One of them that I talked about earlier, Alexandria Real Estate Equities. That's one that I got into relatively recently. Wish I had gotten into a lot earlier, because it is a fantastic company, and they are building life science properties, really focusing in the areas where things are building. So I really like that one. I mentioned Prologis earlier. That's kind of the big whale in industrial real estate, and one that I've owned for a long time, and I'm pretty sure it was my first REIT investment. Held it for a while, is American Tower, which is one of the biggest owners and operators of broadcast communications cell phone towers. It's called American Tower, but that always reminds me that is actually global. And one of the things that I like most about it is that it does have a lot of investment in developing countries, and it's really positioned to capitalize on 5G and the just increasing demand for cell tower space.
Yeah, and then for me, I'm a very new REIT investor, so cannot speak to the small details of all the REITs that I'm invested in. But one of my favorites is Avalon Bay Communities, a consistent Millionacres favorite. I mentioned Stag Industrial. First REIT will always have a place for them in my heart. Industrial real estate is at a very interesting time right now. So definitely that's on my list. And then I would imagine MGM Growth Properties for their for their dividend.